And I have been there with my team. So very enthusiastic for this meeting today and nice to meet you all. Thank you.
Great, thank you. I'm just going through names on the screen here. Ismich or Ismit? Or maybe Angela or Hussein.
Hello, I'm from Bucharest University of Economic Studies. I'm a PhD researcher and PhD candidate. My fields of research are country brand, multinational corporations, country of origin, sustainability, some in these fields.
Great. And how did you hear about the Pitch Clinic?
On LinkedIn.
Oh, fantastic. Good.
Yes. Social media.
Okay. Anyone else want to introduce themselves? Maybe Hussein, since you came in an hour early. Maybe you can't hear me. Okay. Argyri, do you want to say a word about yourself?
Sure. Well, my name is Argyris, I was just introduced. Thank you, Adrian. I'm a partner of Anthology Ventures, and I've been in the consulting industry for more than 25 years and working together with corporations, small, medium, and large, in different projects, as well as being involved with the startup ecosystems since 2010. Mostly in Southeast and Northeastern Europe and the Mediterranean area. Thank you.
Vivi, you want to say hi?
Yes, sure. Hi, everybody. My name is Varsky Vidyurka, and I'm also managing partner of Anthology Ventures. And we have worked a lot as Anthology with a series of startups in providing support for maturing their concepts and prepare them for market readiness and investment readiness. And within VITALISE project, which is the project that organizes today's event, we actually are a partner that is helping in commercializing research results. And yeah, my background is in civil engineering, which is mostly technical, but I'm also involved in the preparation of competitive proposals for EU funding like Horizon Europe. And also I'm involved in the implementation of projects. That's all on my side. Thank you.
So, welcome everyone. My name is Adrian Thresh. I'm also with Anthology. Today we have the first day of a 3-day pitch clinic. There's going to be several topics that we're covering. Today is more of a focus on investment and investors, as well as presenting the results of your research in the pitching process. And then on Thursday, we will continue with value propositions. And then finally, on the final day, which is the following Thursday, the 22nd, we will have a chance to go through various different research proposals that you may, or research presentations, let's say, that you may fix and work on giving you all feedback for them and how to sort of increase the chances of leading to investments through your work. So today the focus, as I said, is going to be on investments. We're going to talk now about kind of the basics of venture capital. And then we are very, very fortunate to have Sterio Anastasiadis with us today. He is a partner at Genesis, which is a venture capital fund, and he's going to talk specifically about tech transfer teams and kind of what it means as an investor to work with researchers that are coming out, or sorry, research-based projects that are coming out of the university as startups. So I wanted to just ask a quick question, and that is, how many of you have any experience, practical experience with investors, or with actually trying to get capital for a startup business? Does anybody have experience with that? Not a lot. Okay, so we're going to do a little bit of a deep dive here. If you have any questions during this presentation, please feel free to stop me and ask. There are a lot of slides. Some I will spend more time on than others. And for those of you who are not familiar with venture capital, this may be kind of a new area, so there'll be a lot of new information. If it's confusing, or if you want me to explain something further, please just feel free, raise a hand or stop me and ask a question. So I'm going to share my screen here, and please tell me if you see it in full screen. Is that okay? Great.
Yes, Adrian, it's okay.
Okay, perfect. All right, so the first thing, we need to take a look at is basically, what are the expectations that investors have, right? So, and in order to do that, I want to sort of take a look at the kinds of capital that are available to, sorry, I'm just moving this out of the way, to us when we want to start a business, right? There's basically two kinds. We're either talking about non-dilutive capital or dilutive capital. And by dilutive, we mean that bringing the money into the business is going to change the ownership structure of the business. So if I'm a single person and I own my own business, and I bring an investor in, right, and I give part of my business, I give, let's say, 20% of my company to that investor, my share of ownership is now diluted, right? It gets smaller. Okay. So as researchers, we're typically used to getting money in the form of loans, or mostly grants, right? Or loans or gifts. Typically, as researchers, we get them as grants, right? And the money that comes in finances our research work, or perhaps as we are building our company, it helps to grow the company, but it doesn't have any influence in the ownership of the company. Okay, sometimes these things, like either loans or grants, will have strings attached to them. I have to have certain things delivered by a certain date. I have to pay interest on the loan. I have to make payments to give the money back, and so forth. But the key is that with non-dilutive capital, it doesn't change the ownership structure of the company. With dilutive capital, which is what we're going to be talking about today when we have investors, the ownership of the company is changed. So if I take money from an investor, whether it's a private person, an individual, or whether it's from a venture capital fund, right, that money is going to be in exchange for an ownership stake in my company. And as a founder of a company, it's really important, before you go looking for investment, it's really important to understand what makes the most sense for your business. So if you do not want to give away part of your company, then you're going to be looking for money in these forms, okay? Loans, grants. By gifts, I typically mean, money that our family will give us without any strings attached. But today we're going to be talking mostly about dilutive capital. So, two different kinds of investors, right? One are individual investors, and the other are institutional investors. Now, individual investors come in basically two different forms, okay? The first one is what we call the 3 Fs, and that stands for friends, family, and fools. It's a little bit tongue-in-cheek there. Fool, I hope, is taken in a good way, meaning someone who's foolish enough to take a risk on a good idea. The source of this money is always going to be their personal money. Typical range is between $500 and $10,000 or euros. Sorry, I should have changed that to euros. And they also will often provide a lot of cheerleading and support for you. A lot of encouragement, really kind of helping you through the times that are difficult and so forth. So friends, families, and friends and families are going to be the first, typically the first investors in your business or your idea. And often they will invest without any kind of a formal contract, sort of a handshake agreement, which is, okay, I understand, you pay me back when you're done. But this is this is often problematic, right? Sometimes we have expectations that are not necessarily met. And so there can be surprises in the end, right? If things don't turn out the way that both parties expect them to, then it can lead to some difficulties. And because we're dealing with friends and family, there's always going to be a lot of emotion involved there. So the best practice is anytime you're going to have an exchange of money, that you record that exchange, document it, write down, this is exactly what I'm getting from you. And this is what all of our expectations are about this. Maybe there's no expectations. Maybe it's completely no strings attached. But the important thing is that you have a piece of paper that says, this is what we decided on this day for this amount of money. So second kind of individual investors are what we commonly refer to as business angels or angel investors. They also invest their own money. And I'll tell you why this is important in a minute. Typically, an angel investor can go anywhere from $5,000 up to $100,000 or euros, right? And often they will bring in friends or people in their network for advice. They can give their own advice, obviously. They can make introductions. Sometimes they can help you out with other services like legal help or accounting help and things like that. And many countries actually have very specific regulations about angel investing. So there are certain rules about the amount of money that you have to have in reserve capital as an individual, the amount of experience you have to have doing this kind of investing and so forth, because a lot of countries will offer tax incentives or other kinds of incentives to keep that to keep the private capital flowing into new businesses. Sometimes the business angels will form networks. This is great because they, as a collective, they can get better access to better companies, and they can also pool their money together so they can maximize the possible returns on their investment. So the two kinds of individual investors, as I said, are going to be friends and family, and then business angels. Institutional investors, right? This is typically how we refer to venture capital funds. These are actually corporations, okay? And so you have a venture capitalist who is the person who works for the venture capital fund, right? When they're investing, they are not investing their own individual money. They're investing the money that is in charge, or that is the charge of the fund, okay? And I'll talk about the structure of a venture capital fund in a little while. A lot of VCs have previous experience before they turned to their careers as investors. They can either be employees in startups or corporations. Some of them are founders themselves, and some of them have experience in consulting and so forth. Many of them are researchers as well. So a lot of times people will start out in one career, and then when they get the hang of the entrepreneurial journey, when they've decided that they want to make a switch and fund other entrepreneurs, then they'll become venture capitalists. And their day-to-day job, I'm sure that Stadio is going to tell you quite a bit more about this, but it's a very exciting job. You get to talk to a lot of really great founders and companies. And then if you find some good ones, hopefully move into the deal stage. So what do all these kinds of investors have in common? They all expect a return on their investment, right? And that return, the amount that they expect, varies, of course, by the type of investor they are. So friends and family typically will want anywhere from a 50% to 100% return, or nothing. Maybe it's 0%, as we said. It can be a gift. But if it is an investment with a dilutive nature, then they're going to want some kind of return. Angel investors are often looking for a 3 to 5x return, and venture capitalists typically around a 10x return. So again, we're not talking about percentage here, right? This is not a 10% return on the investment. It's a 10 times return on the investment. These kinds of investments or investors as well, they will typically look at deals in a particular stage, we call them, right? So for researchers, when you're before you've commercialized the product, when it's still at the demo stage or the prototype type stage in a TRL 3 to 5, that's normally going to be what we call the idea stage or the pre-seed stage. Once you have a fully commercialized product, it's functional, you've got customers, you're selling, it's working in the market and so forth, that's more in the seed stage and the growth stage. So at each of these stages, right, you're going to have a different type of investor. Usually the friends and family come in at the very, very beginning, then you move into angel, Angel investors and venture capitalists as well they can often combine in a single investment. And then after it reaches a certain amount, it's typically too expensive for angel investors. So that's when you get into mostly just VCs. Now, the thing about investing, obviously, is that there's a great deal of risk associated with it at any point in time, right? Any point, the company can always have a problem, or there can be some sort of an external event like a pandemic that can cause things to fail. But in general, the earlier you go in as an investor, the higher your risk of failure, right? Because at this point, the company doesn't have any customers yet. It doesn't have necessarily a functioning product yet. It's very, very early days in the market. And so the chances that this company is going to fail are very, very high. On the other hand, you're also investing the lowest amount of money at this point. So there's an inverse relationship there. There's another kind of investing that I'm not going to spend too much time on, but I did want to mention, and that's crowd-based investing. It's really, really good for non-dilutive fundraising if you're doing donation crowd-based funding. Maybe you've heard of Kickstarter or Indiegogo, GoFundMe. There's a lot of popular consumer donation-based crowdfunding sites that you can get into. But it is very expensive for the founders to set up and run a crowdfunding campaign. So it's not necessarily the right solution for everyone. But if you don't want to go the traditional investor route, you can look for crowd-based fundraising. There's also equity-based crowdfunding, okay? And that's actually become much more popular over the last 5 to 10 years. It's where groups of individuals will directly invest into the startups, and they do get some equity in return. With the donations, you don't get any equity. Typically you just get maybe a reward or a product back again. So with an equity crowdfunding situation, this is actually a company that I know. I actually have one of their products. They make solid soaps and shampoos, and they have packaging which is 100% compostable. So for a company like this that has a physical product, crowdfunding is actually a really, really great option for them. The founders managed to raise almost 132,000 euros with 171 investors here. So they surpassed their target, and they ended up giving 4.57% of equity in their company. So if they had gone to a venture capital firm or even to an angel investor, they might have had to give up more equity. We don't know about that for sure, but it's possible that to get this money, they may have had to give a higher percentage of their company away. So in equity crowdfunding, the startup company has to have a proven product, right? And they really need to know why it is that they're going to connect with their investors, because this is a public campaign, and you need to be able to be attractive enough to the investors that they're willing to invest just over the web, right? They're not going to be meeting with you and talking to you. They're going to be seeing what the materials are on the crowdfunding site and making a decision: do I contribute or not? And then when these investors do invest, all the investors are rolled together. There's 171 of them here, but most probably not all 171 of those investors are going to appear as owners in the company. It's going to be rolled together into what we call a special purpose vehicle. So when you look at the shareholders of this company, there's not going to list 171 of them. It's going to list one from the crowdfunding site, from Crowdcube in this state. Okay, so let's talk a little bit about the mechanics of investments. We mentioned exits, right? We mentioned the return on investment. So venture capitalists and angel investors are going to get their money back when they exit the company, right? And as we said, if we want a 10x return in 8 years, that means that if I make an investment of 325,000 euros, I am expecting 3,250,000 euros when I exit the company. And the way I'm going to exit is I can sell my shares either to another investor, to another VC fund that comes in at a later stage, or if the company goes public, meaning if the company is offering itself on the stock market, right? It's no longer taking private investment. Now it's getting money from anybody in the world can buy shares in that company. And basically, it means that the shares that I have originally bought with my 325,000, right, have to go up in value by 10 times their original amount. So most venture capital funds are going to want to see a return on their investment within 5 to 8 years or so. But as I mentioned, Stadia is going to tell us more about that in a few minutes. Okay. And I'm also going to let him talk about how he chooses companies. So I'm not going to spend too much time on this as well. Typically, when you're profiling a startup, you want to talk to them about the three basic things, right? The product that they're making, the market that they're targeting or operating in, and the team. Who are the people that are building this product and going to be, you know, building the company? Who am I working with here? What am I working with? And within what kind of an environment am I working? What is the market like? So again, we keep coming up with this 10x number, but it's really an important factor, because if I'm going to put money into a company and expect a 10x return on it, I need to know if their solution is up to speed. Is that going to really provide me with the return I'm expecting? And how do I figure that out? Maybe I need to see a demo version. How can I understand the very, very basic nature of this product and extrapolate what it's going to look like in 5 years or 10 years or 20 years, right? How well is this thing built from the very, very beginning? And what kind of a problem is it solving? What is the real need that this product is meeting? All right. Various kinds of details will come out here. But these are the sort of initial questions that an investor is going to have in their mind when they're talking to startup founders and trying to understand what they're getting, what the potential is that they would be contributing to. Now, with research startups, many times they're still way further back in the development timeline, let's say. So there are investors that will ask these questions and understand that a lot of the answers are still going to be, or they're very, very unknown. We're talking hypotheses at this point, because research typically has a much longer time to market. But they're still very valid questions. It's really important to have all of these issues in mind from the very beginning when you're starting to take your research results and build them into a company. There's certain kinds of metrics that investors look at, and this is also very, very important to have from the beginning. Even if you don't have any of this information because you don't have any customers yet, you need to start thinking about what it will look like when you do have customers. So some of these metrics that are important are the customer acquisition cost. How much does it cost me as a company to bring one customer in? Okay. And how much is that customer going to provide me with in terms of income for the duration of the relationship that I have with them? Okay. Other metrics like churn, which is how many customers do we lose on over a given point, whether it's a month or a year. How long is our cash going to last? What kind of revenue do we have over a year? And so forth. I won't go too deep into these metrics, but they're things that any startup founder needs to be familiar with and needs to track constantly. Okay, even if it's before revenue, when you don't have any customers, you need to be paying attention to what your competitors are doing and what their metrics are in these kinds of categories. So just as an example, if we have, let's say, a robot for care homes, this is a very big deal in the kind of healthcare space right now. We have two different products that we're selling. We're selling the actual physical robot, and we're selling also the application that helps us communicate with that robot and communicate with the patient. So there's going to be two different kinds of prices and two different sets of metrics for each of these products, right? So as a startup founder, you need to be aware of what are the various different values that are associated with my one product and with my other product if I've got both of these. Okay. And that's the kind of thing also that an investor is going to want to look at as well and make sure that you as an entrepreneur understand what are the particular factors associated with all of the different things that you're selling, and who are you selling them to? Because selling a robot to a care home is a very different process than selling the application to the patient and the family in the care home. And you need to know if you have to deal with both of those, or if you can just have the care home be the ones who bring in the patients and the family into the application. So those are the types of questions that as a founder, you should be asking yourself and helping to build into your business as you're moving forward. And they're the kind of questions that you should expect to hear from an investor when he's looking or she's looking to make an investment in your company. Okay, various different stages I mentioned on that curve before with the risks, right? We have, let's say, pre-seed stage. The investment amounts typically run anywhere from 25 to 500,000 euros. Seed stage, it goes anywhere from, let's say, 300,000 to 5 million euros. And getting into Series A and Series B and so forth, the amounts obviously go up. The type of investment that will be made here, I'll talk more about this in a minute, is going to vary. It's either going to be what we call a convertible security or an equity-based transaction. Okay, and at each of these different stages, right, the investor is going to consider some different things. And they're going to look at the team and the product, always. They're always going to look at the market size, and they're going to look at the customer acquisition cost and so forth. But as the company moves forward and grows, certain other metrics come in that are much more important, right? At a point where the company, where it's clear that the product has been adopted by the market, you have recurring revenue, you have customers, you have a stable trajectory, hopefully that's increasing and going, not stable, but stable meaning it's increasing and consistent. Sorry, not stable. So you can make some predictions about where the company is going to be based on what the facts are today. So the more money that goes in, the more attention is placed on the revenue and the rate that the revenue is increasing. In the very beginning stage, the pre-seed stage, which is where a lot of research results initially enter the market, typically the most important thing is going to be the team and the product. Okay, let's take a slightly deeper dive into venture capital. We'll talk about how funds are structured. This is a very, let's say, generic, simple way of looking at a fund. As I mentioned, a venture capital fund is a corporation, right? And within that corporation, there are general partners who are the fund managers, right? They're the ones who go out and find the startups and make the decisions whether or not to invest into companies. Now, the money that is in this corporation, right, comes from what we call limited partners. And limited partners can be foundations, they can be companies, they can be other venture capital funds, they can be individuals. But they all will pool their money, invest it into this fund. So as limited partners, they're investors in the fund, and the fund, the corporation, then goes and invests into a portfolio of startup companies. So that's just a very basic outline of how the structure of a venture capital fund works. Most of them in the early stage are what we call closed-end funds. That means that they have approximately a 10-year lifespan. So typically that's 5 years to invest all of the money into the portfolio of startups, and then another 5 years to divest the money. So the exits that funds are expecting will come in that second 5-year period. The money's raised, right? We start out in the beginning, the fund opens, the money's deployed through investments, and then those investments are realized. And if everything goes well, there's a nice payout to all the limited partners. There's another kind of fund called an evergreen, which means that they are raising money on a continuous basis. They've got ongoing investments and divestments, and they can participate. Also, some of these evergreen funds can participate in public companies as well. So, and do participate in public companies as well. So for instance, Sequoia Capital, which is one of the largest and most well-known venture capital firms, actually does have holdings in public companies. But evergreen funds are not nearly as typical as closed-end funds. Most startup funds are closed-end. Are there any questions? Have I lost any of you guys yet? I can't see your faces, I'm sorry. So any questions? No. All right. Well, most venture capital funds have a focus. They typically that will be something that helps them guide their investment choices, right? So it can be a sector focus like medicine or climate or education. Some funds have a specific technology that they work with. Some of them are interested in having kind of a net positive or an impact focus. So they'll work on, let's say, in particular geographical regions that are underserved, or maybe they work on a specific kind of ESG criteria. And sometimes they'll even be, very common fund focus is on the business model itself. So there are a lot of funds that will invest only in software as a service, some that will invest only in marketplaces and so forth. And they specialize in these types of business models. And it's great for their portfolio companies because there's a large amount of wisdom and kind of networking that goes with an investment of similar companies. So if I have a marketplace business and I get an investor that only invests in marketplaces, that gives me automatic access to a huge amount of knowledge and experience that will help me grow my company. And then obviously many funds focus on a particular stage of growth. So they can be early stage, investing in pre-seed or seed startups, or they can be growth stage where it gets into Series A and B and then later stages. And this has a lot to do with how much money, how much capital they have to deploy. So typically, an early stage fund is going to make much lower level amounts, right? They're going to invest, anywhere from 125 to, let's say, 500,000 euros per company in the beginning. And then they're going to save some of their money so that they can reinvest into those companies later. But they don't start out at the 1 million range, right? So a Series A or Series B stage fund is going to make their investment starting out typically around 500,000 to 1 million as the initial investment. They often have a thesis as well as a focus, okay? And this is basically a rationale that they use to sort of, check to make sure that everything is aligned. So they're gonna look at things like the size of the company that they're targeting, the growth rates, what the valuation is, again, the market sector, the business, and so forth. And they also need to make sure that it's aligned with the fund's goals, right? So what kind of risk factors do they tolerate? How long do they have left in their fund's lifetime? And what kind of market trends are out there that they need to fit that investment decision into? Now, timeline. How long does it take? Typically, you should expect between 6 and 9 months from the first time you talk to an investor. Sometimes it happens much faster. Some investments are closed in 3 or 4 weeks, but this is definitely the exception to the rule. From the time you first start out pitching an investor and having your very first meeting with them to the time that you actually get the money in the bank, it's going to take a while. And this is really important because many founders underestimate the amount of time it'll take, even when they've got a great relationship with the investor. All of these processes take time. And so having that in mind allows you to time the use of your capital, right? If you know that you're going to run out of money in 6 months, then you know that you have to start fundraising today, right? If you know that you have enough money for 18 months, then you can say, okay, I'm going to start fundraising, but I'm probably not going to start until the end of my 3rd quarter this year, something like that. So it's important to just keep the timeline in mind. Another thing that's really important to keep in mind is the risk, right? From an investor standpoint, as I mentioned earlier, the very beginning of the startup's lifetime, when they're little tiny companies here, the risk is going to be much, much higher. As the startups grow and they get bigger, obviously, the risk level decreases by a lot, but the cost of the investment goes up. So the more valuable the company, the more expensive it is for me to invest in it. It's less risky, but it's more expensive, right? On the other hand, and I'll let Stereo tell you much more about this in his session if he has time. On the other hand, as a VC fund, I am expecting, as I said, a 10x return, not just on my companies, but on my fund. So if I want my entire venture capital fund to return 10x to my investors, that means I have to make a lot of bets on a lot of risky companies. And the bet is that of the one of the companies that I've invested in is going to be enough, well, maybe not one, but a few, a very small handful, 10% of the companies that I'm invested in overall are going to grow big enough for me to be able to return 10 times the amount of my fund. Because I know that many of these are going to fail, right? Many of these are not going to make it out of this area here. They'll grow a little bit, they'll either get bought or they'll die. A few more will grow a little bit bigger, a few more will grow very, very big, and then maybe one or two are going to hit the unicorn stage. And a unicorn is a company that is valued at 1 billion euros or more. So here's my unicorn here. Out of 100 companies, I get one, right? This is sometimes called the power law, and it basically says that we assume that 90% of our investments are going to, they may not fail as companies, but they will fail to return any sort of meaningful increase in the value of the investment. Okay, and so typically we need, if we're gonna get a 10x to a 30x return on our fund, right? We need to target companies to invest in that are going to be able to give us up to 100x of our investment, because they have to compensate for all these failures, right? My limited partners, all the people that put their money into my fund, are expecting money back. And if all of these guys can't bring back meaningful returns, then I need to bank on a few. So maybe these green ones here, 1, 2, 3, 4, 5, 6, 7, let's say 8, 9 of them are going to bring back maybe 10 to 50x on the investment that I made. But one of them is going to give me, in conjunction with these other ones, one of them is going to give me 100x, because all of these 90 that don't succeed, right, are not going to be enough to generate the returns I need to give them back at the end of my fund to my LPs. Okay, so how do we determine the value of a company? Right? Do we just pop a number on it? No. What is the value of a company, first of all? This is an investor saying, okay, well, how much is the company worth, right? What does that mean when I invest in it? How much of a stake am I going to get in this company? And that will help me understand how much can I potentially get when I exit the company. So this is an overall monetary value, right? It's not the same as the revenue that the company makes, the profit it makes, the number of sales it has. Definitely has nothing to do with the money in the bank, right? This is basically, we say if this company as a whole were to be sold right now, it would have this price tag on the company. Again, not how much money they have in the bank. Okay, and the valuation is important because that's what's going to determine the price of the shares that you're buying, right? So every investment has to take that valuation into account in some way. With public companies are listed. They're on the DAX exchange, the FTSE, the New York Stock Exchange, and so forth, right? So their stock is traded regularly. Anybody can buy it or sell it, and the stock has a price. It fluctuates. It goes up and down, but the overall value, right, or what we call the market capitalization of the company, can be seen at any given time, right? So Apple Computer yesterday, or the day before, when I checked the price of their stock, okay, translated to $2.95 trillion. That's the worth of Apple Computer, and we get that number, the worth, by multiplying the total number of shares, right, the total number of stock that's out there, by the share price. So 2 or 3 days ago, the share price was 188.85. You multiply that by 15.5 billion, and you get a very nice number of almost $3 trillion. So with a public company, it's very easy to understand what the value of them, or what they're valued at, their valuation. With private companies, however, it's much trickier, right? Because their shareholdings are closed. Yeah, so the stock can only be purchased at specific times during financing. And the value of those shares is going to be derived from the value of the individual shares, that are sold during the financing, is going to be derived from the valuation. Okay. Now there's various different ways to calculate it. I'm not going to go into detail on this, but just so that you can hear a few of these terms. One is called discounted cash flow. Another is multiplying the revenue, or what we call an earnings multiplier. And most investors are going to use a combination of a couple of these calculations. They will also go in and look at similar companies that have already gone through a financing, that have already raised money. So they want to say, okay, well, company, I'm thinking about investing in your company. And I know that I invested in company X 3 years ago. And when they were at your stage, this is basically what the numbers told me. So it's important to look at both the sort of methods that they use, but then also what's happening in the same sector that you're operating in, because those are sort of real-time indicators of what company valuations are going for at that point. So there's a combination of factors, right? They look at the kinds of assets that the company have, both the tangible and intangible assets, right? So that can be anything from IP, right, and intellectual property, to formulas, proprietary software. That's, let's say, intangible assets. Tangible assets like trademarks and copyrights, and sorry, that's probably under IP. But tangible assets can let's say robotics. You have actual product and so forth. In the team, and this can also sometimes be included in assets, right? They'll look at the founders and the senior staff and understand how much experience they have, what are their key skills, and how important is this team to the company. And then also what kind of traction you may have. So if you've already managed to make some sales, if you're bringing in revenue, or if you've managed to turn a profit yet, those are all important kinds of internal factors that they're looking at. External factors is going to be the market size and what's happening. Is the market expanding? Is it contracting? What kind of competition is there? And what sort of funding climate they're looking at. So after or during the pandemic, in the very beginning of the pandemic, everybody sort of looked at this as being a huge contraction in the funding climate. There was a big there was a slowdown, let's say, in the amount of money that was being spent by investors. There were very fewer new financings, and much more of an emphasis put on keeping the companies that they already had functioning properly. So in that kind of a funding climate, where it's a negative funding climate, it's going to put pressure to lessen the valuation of a company. When you've got an expanding funding climate, then valuations tend to go up. They tend to get inflated. So when you make an investment and you want to calculate how many shares you're going to get, or think about it, right? It's a very simple formula. It's basically the amount of investment the amount of money that you're putting in, right, divided by the total value of money at the end. So if the company is valued, if we reach a valuation on a company of 1 million euros, and an investor puts 250,000 euros into the company, then what we call the post money, right? The initial valuation is the pre-money. The post money is 1.25 million euros, okay? So the investor's share of this is 20%, right? Not 25%. If it was on the pre-money valuation, it would be 25%. It's on the post-money valuation. So it's a very simple formula to think about, okay, this is the number of shares I'll get in the company. Right? Or the ownership, let's call it not the number of shares, but the ownership stake, the share of the company that the investor will own. When you actually come down to negotiating a deal, things can start to get a little bit trickier. And that's mostly because with early stage startups, especially research-based startups, right? Valuations tend to be very aspirational, meaning we don't have a track record yet for this company. There's not a lot of facts to go on. Okay, there may not be significant sales or revenue. We still don't know quite where this company is going to go in the market. So there's a lot of suppositions, a lot of hypotheses there. Typically, a founder is going to think that their company is valued at a certain amount, right? So in this case here, we have a founder who needs 500,000 to help them market their product and grow the company, right? And they think to themselves, okay, I'm willing to give up 10% ownership of my company, right? I need 5 million, or sorry, I need 500,000. My company, I think my company is valued at around 5 million, right? So the post-money valuation of 5.5 million means that I'm going to give an investor 9% of my company, right? Well, the investor comes along and says, actually, to me, I think it's more like 2 million because they know the market, right? They may have and made investments in similar companies. They're certainly watching similar companies be invested in. And they have a better clue of what's kind of on the street, what's happening out in the real world. So they say, actually, no, your company's not worth 5, it's worth 2. I'll give you the 500,000, but I want 20% of your company, right? Because for me, the valuation is a much lower number. At that point, the founder has to make a decision of how much they need the money. Okay. Now, when this kind of negotiation happens, if they decide to agree to disagree at this point, right, they can do what's called a convertible security, right? Now, this is when the investment will go into the company, but they won't decide on an actual valuation yet. There's still room to move that needle from 2 million to 3 million or possibly even higher, because there's not enough data to say this company is actually worth 2 million or 5 million, right? So the investor and the startup founder agree on what's called a convertible note. And the convertible note means that the money goes into the company, right? And it will either be repaid as shares, equity, or it may be returned as cash. Okay, and then if it's going to be returned with cash, there's going to be a pre-specified amount. So it's typically 200% more plus interest. So this convertible note is actually a way for the founder to get the money and the investor to postpone the value of the company until it gets to a proven point, right? The convertible notes typically will, these are the various terms that they have that'll have the amount of the loan, which is, let's say in our case, 500,000, right? Plus maybe 6% interest. That's might be high, 3%, whatever. It'll have a maturity date. Typically they're anywhere from 18 to 36 months, right? And that means that the money is either going to be returned or it will convert over into shares at that point. There can be a discount, meaning that the investor can invest a second time at a cheaper rate, like they can invest, but they get a 20% discount from what the other investors are paying. And there's other terms that dictate things like oversight on certain kinds of decisions. Maybe they want to put some restrictions on what the funds can be used for, and so forth. So but the key here is that convertible debt means that no shares are actually exchanged at the time of the investment, right? There is a promise for some kind of a conversion to happen sometime in the future. The money goes in, and the investors and the founders are together in the company, but there's no actual exchange of equity at that point. So this is a screenshot from a term sheet. You can see here they talk about the pre-money valuation, right? The total loan amount is 50,000. That was 450,000. Total loan is 50,000. The net loan, right, is reduced because they want a capital contribution from the founders. Okay, so and this actually sets that out also in terms of what the conversion was for going from one currency to another. The maturity date, right, 2 years. Okay, so that gives us 24 months, and the interest rate is going to be 1% per year if I have to pay it back. Right, so this is the kind of terms that you'll find in a very, very simple convertible note. Now, if the investor and the startup do agree on a valuation, right? They say, okay, yes, we both agree this company is worth 3 million euros or 8 million euros in this case here, right? Then we can go ahead and do what's called a priced round. Now, it's priced because we actually put a price tag on the company, we put a price tag on the investment, right? So the amount of equity and the number of shares is settled. The investment's closed, right? We have a 8 million pre-money, 2 million raise. The post money is 10 million. So the investor's share is 20%, right? The type of stock you're going to get in these kinds of transactions, of investments, can either be preferred stock or common stock. And typically the preferred stock will come with certain kinds of rights that the common stock does not have, okay? Now the fund is hoping that the value of the company is going to increase so much that the value of their own shares is going to rise exponentially. As we said, we really want to hit that 10x return if we can, or maybe even more, 100x. So the classes of shares that I was talking about, common stock, right, and preferred stock, you can see often will vary with the investment terms. All right, common stock is very simple. You get 1 vote per share of stock. The liquidation, meaning when you get out, is normal. There's no exceptions or no incentives there. And typically, this is the kind of stock that founders have. They can give it to employees with options and so forth. Investors often, but not always, will ask for what we call preferred stock. Sometimes those shares can have multiple votes. So in a shareholder meeting, the amount of shares that I have is equal to, or the influence from my shares is equal to more than what the amount of shares is, right? I may have only a 10% stake in the company, but if I have multiple votes, a 2x vote on my shares, then I have 20% decision-making power in any kind of negotiation. Sometimes they have first out liquidation rights, meaning that if there is, if the company is sold to bought by another company, then my shares go out first. Or if other investors are coming in, I have the chance to sell my shares to those investors first. Okay, and as I said, those are often the kind of preferred stock is often what's issued to VCs in the later stages of investment. So when you're talking about mostly Series A and above, then they'll start asking for preferred stock. Okay. There are certain kinds of rights, as I mentioned, that can be given to incentivize or to, let's say, make investors happier with their deals. Again, Stereo is gonna give you a better insight into this from his own perspective. But pro rata rights typically have certain contingencies in them, right? Well, they'll allow the investor, okay, it can give them the right to engage in a future fundraising round, for instance. So I can say, I can participate in the next round. I don't care, you can't tell me I can't. I reserve the right to do that. Sometimes it allows me to maintain my ownership percentage in the company, right? And I'll give you an example as to why that would happen. It's very, very important. These kinds of rights are important for early investors because they're the ones that are making the riskiest investments, right? So they want to know that they can protect their ownership stake in the company in case it turns out to be a very, very successful investment. They need to know that they're not going to get diluted in later, or at least not as diluted in later investment rounds. And sometimes investors will ask for the right. Okay, not the obligation. They don't have to do it, but they want the right to invest the proportional ownership in the next round of financing. So if they have 10% ownership and another investment round comes along, they have the right to reinvest to maintain that ownership, right? So whatever it means, whatever they need to maintain their 10% stake in the company, this term sheet will allow them to do that. It says, yes, you have the right to invest that much money. Now, if we have 20% of a company at a seed round, and later we go into a Series A round, okay, they can participate in that round in as much as 20%. So they can either invest to protect their stake or invest the proportional ownership, 20%, into the next financing. This kind of a thing is not going to be done by an angel investor typically. But a venture capitalist can say, okay, we think this is a really, really amazing opportunity. We know this company is going to be huge. And so we want the right to be able to maintain that 20%, at each financing for the next 3 financings down the road. Okay. And it's all about not being diluted, meaning not the amount of shares that I own or the amount of ownership that I have in the company is not going to get any less. It's going to stay the same. Okay. It's also, this is another important thing, it's also a confidence building measure, right? Because if you have new investors coming into the company, they want to see that the current investors are going to stay there, that they have enough confidence in the startup that they're keeping their money there, right? So if it's seed stage fund financing, you invest $3 million, right? Let's say we come along a year or 2 later, things have gone great, the product is really taking off, you've passed all your clinical trials, you've gotten your CE mark and been, and regulatory approvals, and so now you need to raise a Series A round, and that's going to cost 15 million, okay, or let's say more than 15 million, right? So at this point, as an investor, I have the right, because I have my pro rata rights, to reinvest to maintain the stake of 3 million, to maintain my stake in the company. Sorry, so I can put in another 3 million, right? I will make the investor happy. The new investor is going to make me happy, right? Because they're actually protecting my investment. Yeah, the company is getting the money that it needs. I can't put in the full 15 million, but I can put in another 3, right? And that means that the company is going to get as much as it needs to go forward and keep growing and expanding. Sometimes, even if you don't want to invest, it's important to do it because it builds that investor confidence from the other side, right? And so you can that way you'll be sure that you'll keep the company going. All right. Because if you lose the investor, if the 15 million doesn't come in, as an early investor myself, I have to decide, do I continue to fund this company, right? Or do I let it go bankrupt? And if it goes bankrupt, then all I have left to do is try to sell my assets and recover as much of my initial investment as possible. So sometimes it's a little bit of a game in terms of, okay, do I want to invest? Do I not? What does it mean if I don't invest? And that's something that that investors think about when they're looking at the company's progress down the line. Okay. This is just an example again from a term sheet, right? So the non-dilution clauses, reinvestment, lender shall have the right but not an obligation to participate in the next financing round with the amount of up to a 50%, right, of the next financing round. That's a lot. Future funding rounds, the right but not the obligation to participate in all future funding rounds of the company. So this is the kinds of things that actually do end up in term sheets, and it's important as startup founders to know what they mean. I'm going to take a quick break here. I think this has been a huge amount of information. And see if any of you have questions, comments, or things that are not making sense, or anything that you'd like to contribute. Nothing so far.
Thank you, Adrian, for such a nice introduction. But I have one question, maybe because I hear it in Shark Tank a lot. They say like equity, like I would invest this many 1 billion with 2% equity, 3% equity in your company. What does that mean, equity?
Okay, so the equity is the ownership in the company. The equity, 100% equity is the entire value of the company, right? So if an investor puts in money and that money is exchanged for a certain amount of ownership in the company, they buy a part of the company with the money. So if they're offering, or let's say if someone is raising money, right? Say, okay, I need 1 million euros. And in exchange for that 1 million euros, I will give 5% of my company. I will give 5% equity. It's the same thing. It's the ownership stake. So when I was talking about the difference between the valuation of the company, right? Mm-hmm. The reason that it's important, did that make sense? The reason that it's important if you decide on a specific valuation or not, right, is because if you decide, then that equity stake is set right there. right? If the company is valued at $10 or 10 euros, okay, and you give me €1, I give you 10%. We both agree, right? And you now own 10% of my company. If we say it's probably worth around 10 euros, but you as the founder and me as the investor disagree. You think it's more like 12 and I say it's more like 8, right? We agree to disagree. We say, okay, whatever it is, it's worth investing in, right? So I'll give you the money and we'll wait for 18 months or 24 months, right? We'll wait for 2 years. And at the end of 2 years, we will decide, we will come to a valuation, right? And that number is going to determine what the money that I give you now is worth in equity. So if I give you, if you are raising $1 million, if I give you €1 million, and we don't know what your company is valued at, 2 years from now, your company is valued at, let's say, 20 million, right? My 1 million allows me how much?
20.
21. Sorry, 1 divided 21. It's about 5%. If I do the math right. Maybe I'm not doing the math right. Anyway, the point is that the actual exchange of equity happens in 2 years. Okay, because we didn't put a price tag on it when we signed the papers. When I gave you the money, we didn't put a price tag on it. We agreed that we will figure out the actual worth of the company, which determines the worth of my investment in you. We're going to figure that out in 2 years. Does that make sense? Sort of. Okay. Any other comments or questions? Okay, Stereo is here now, and I think we can switch over to him. Are you ready?
Hello, everyone. Can you hear me?
Hi. Welcome. Yeah. Vivi, are you here?
Yes, I'm here as well.
Great. Okay, I'm gonna stop my presentation and possibly pick it up again on Thursday. We have Stereo here, and Vivi, I think you're gonna lead the conversation with him. So hopefully we will see you all till the end of today's session, but then also please come back on Thursday, and we will be doing more work with investments as well as with value propositions and presenting research results. So I'm stopped sharing and turn it over. Whoops, sorry.
Okay, basically then we can switch the next session that we have, since we have Stereo Anastasiadis here at this moment. So we can switch the next seminar on mastering the art of persuasive presentations for research-based startups after the discussion we will have with Stereos. So hi, Stereo. Very pleased to have you here with us today. And we would like to initiate this discussion asking you to describe us a few things about Genesis Ventures. What is the scope of the VC that you're participating at? And then we will jump into some questions and answers for our attendees. We cannot hear you.
Yeah, I was just on mute. Thanks
Okay.
for the invite. It's nice to kind of see more individuals that are interested in this space, which is a space that I got involved with when I was in North America, and my partner Dimitri while he was in Asia. So the experience of being part of a startup from 0 to 1, then also making some angel investments personally in North America and then in Greece, and participating in the funds led us to a path where in the region of Southeastern Europe and Greece specifically, we found an opportunity where early startups, pre-seed startups, and I saw some of the nomenclature kind of mentioned in the previous presentation, is our kind of sweet spot. We invest in teams that are forming very early, probably maybe not even product market fit, for sure, no necessary constant revenue, all the way to teams where they've been together for a while, there's a product that's been out in the market. And so our range, and have some revenue, and so our valuation range is in kind of that 1.5 million to 8 million range, and we give tickets of 100 to 400K initial funding tickets, and we also do follow-on rounds. We've invested to date in about 35 teams in the past 2 years. And quite a few of our year one cohorts have started doing follow-on rounds. And our backer is the European Investment Fund, where they've given us 20 million to do this work. And we've also raised 5 million private money from angel investors. So our total pool is 25 million to run through the entire journey of our fund. So that's our background. We're based in Athens. We try to be in, we're a small team trying to be in as many places as we can, in and around the country, including universities, and then doing some things abroad as well.
Excellent. My first question has to do with whether you had the chance to invest in research startups, so teams that are coming from universities, from research centers, and what are the insights that you have gained from this process? I mean, what are the specifics that you have encountered with those teams in particular?
Yeah, a really good question. Specifically in the region, we've had interactions with almost all research centers in Greece that are tied to the universities. We have had deep discussions with 6 teams in our 2-year in existence, and we've invested in 1 team, specifically from the University of Thessaloniki, Apithita. It's called Progressive Robotics. The team is in its early stages. They have now graduated outside of the university and have their own private company. And with our funds, along with our angel investor funds and the connections, they've been able to make a first installation in a factory. So they've had like a first customer. I'll give you a little bit of kind of the insights that still need to be developed as a muscle in this space. One, awareness of how venture capital works. It's very light in terms of where the money comes from, how the money is used, and in general the life cycle of how then you go to the next step. Because these are not grants, these are not like things that you just apply and get and then you proceed. There's actual exit criteria, so the money will last you for a certain period of time. You need to meet these targets in order to be able to get more funding for your next round and keep that journey going. So that entire space is new, and most of the time we need to do a lot of education on kind of the details of how that works. 2, we don't expect teams to be like out of the gate kind of doing the huge progress. It takes a while to nurture something and make it good. And so if the teams have the mindset where maybe in 7-8 years they could be making annually, I don't know, 20 million, 30 million, 50 million revenue a year, that's where their head needs to be. We're not saying that businesses that make a few million a year and have staff is not a good business. But for it to be a VC investable and scalable business, it needs to reach in that time frame, plus or minus a few years, that type of revenue, plus or minus some millions of dollars. So that's the second thing that it's important to kind of keep kind of making people in the universities aware. The second thing is the commitment, because when you're in the school, the commitment is protected. It's like, I can be there and do my research and all that kind of stuff. But what we need to make sure is that the teams understand they need to be full-time committed to this venture, and hence this moving to the private world is critical. So the founding team must be on board 100%. And in that case, the university professors that provide that type of support need to understand how the IP is going to work, how that's going to be revenue-wise and ownership-wise going to transition out to the outside world. And so having the support of the university professors that are with those teams are critical for the success of the outcome of a private company. And we've been to the schools and we've done this type of talk, and then potentially we've also had them as part of our accelerator. And so only one has been able to kind of meet those three things. And so there's a lot of work that needs to kind of be put into establishing that type of culture. We believe that we'll find a few more over the next few years. That's why we're still here, and we'll continue kind of playing a role. Hopefully I've given you the current state of affairs and some of the challenges and some of kind of what the direction we need to head to. I know there's a lot of folks here that are not Greek. I don't know if this stuff applies to other schools. Coming from like a North American background, a lot of these things have been streamlined and addressed by the universities and the governments. And so in many situations, I'm not saying they don't exist, but a lot has been kind of streamlined.
That's great, and this is very useful insight. And my next question is very much related to that. I mean, you have been in North America, and then you are operating now in the Greek ecosystem. If we go a few years back, we could let's say categorize it as rather immature ecosystem, innovation ecosystem. What factors do you think that are impacting the way that the ecosystem changes and has changed over the course in recent times? And how do you think the interest in research organizations and research institutions and universities have transferred from pure academic research to research that can be actually and potentially commercialized and create? So we have outputs from our research, and These outputs means commercial products in the market. So which factors has played a role towards that direction? And how would you compare this from your experience in North America?
Yeah, good question. Probably needs a lot of back and forth to kind of go into, you know, a lot of the details. But at a high level, I feel the influence that researchers, PhDs, master students have had by you know, some exposure to external ecosystems have really helped out. There's a huge influence and, you know, activity happening in other schools that, you know, people pick up here, and so the research becomes more focused. It becomes more top of mind material. There's lots of schools, you know, for example, that have done a great work in image processing in Greece. That has to do a lot with machine learning and stuff. A lot of effort has been put into robotics and in Apithita, for example, outside of that team we invested in, there's lots of good work happening there. So the specialization and being part of kind of the you know, at the edge of technology has started to shape up a little bit. As you can appreciate, this takes a little bit more time to start getting away from all the, you know, the legacy, you know, thinking. The second thing that I think is showing a little bit of progress, and you can see that in some of the investments that have happened in agriculture and the like here in Greece, is that they're actually trying to solve real problems. It's not happening like as much as it should, because I still go to like university presentations, and professors talk about, you know, problems that they've been working on for the past 7, 8, 9 years. But well, to me, that just doesn't exist, you know, that much anymore. And so it's great to see schools, you know, drive, you know, that type of problem solving approach. In terms of like, for your second question, and I hope I answer it as directly as I can, I think the ecosystem needs a lot more support and education around how useful at the end it can become, because it can be a win-win both for the individuals as well as the university and the investors, to be able to go private, because that's where like the money is. That's where your support's going to be able to actually make this global, like be able to like get it outside and available, you know, to your customers. And so if that like culture of entrepreneurship starts kind of leveling up, I think the entire ecosystem will reap the benefits from like all of this. Hopefully I've answered your question and
Yeah.
you know, and as concise as I can, but I think there's still a lot of details, you know, behind how you would need to make things work in Greece specifically.
Yeah, certainly. And this is a fact. And what I would like to focus now is you are in a position that you see many teams each month, and you also have the chance to see research teams and to try to understand results that are coming out from research. it's very crucial that the researcher appreciates correctly the time that needs to go and seek funding to a VC. When do you think this time is more appropriate? When should the researcher decide to take on the next step and knock on the door of a VC?
The two things that are critical for answering those questions, one is the team. Like, do you have the founding team? It could be one researcher, two researchers. It can be a really senior student, PhD students that are in the process of getting their degree and the like. So making sure you have a founding team that's on the same page, I think is critical. The second thing that I find most of the time is hard to kind of assess with a timing perspective is, can you articulate clearly that this is solving like a real problem, something that, once you start putting the code in the system and it's actually working, will this be used by businesses or consumers? And you can attach like a business plan behind it that translates into revenue. And I think there are techniques that are out there. We try to teach them in our accelerator that help assess, an idea, that help assess, what is the right, business plan and approach. So the team, and those two touch points, the team and the problem, solving a real problem, are the two most important things. I'm not even going to talk about the research. It's validated. Papers have been published. IP has been. I mean, that's what you do when you're in a research center in a university. So it goes without saying that that's the underpinning. But being able to translate to those other two needs is critical. I wouldn't move out of a school unless you have those two things checked.
Mm-hmm. And this is quite an important lesson and a key takeaway for all of us here today. So the team and clearly articulating what is the problem or what is the need that we're trying to solve is crucial before we decide to go and seek pre-seed funding. And well, my next question is about do you find that tech transfer, I mean, it might be more, there might be more opportunity to identify tech startups in research organizations or coming out from researchers. Is this a priority for the startup ecosystem, the tech transfer, or to fund research results that are based on innovative technologies? Is this a priority, or do you also find interesting cases in other sectors?
Every VC has its own kind of philosophy and its underpinnings. I think in a research facility like a university and the like, I'm sure they do things around economics and marketing. Not a lot have come out of there that become kind of the underpinning of a big scale up, you know what I mean? Usually those things evolve through the market and the needs the consumers and the businesses have. So the other stuff that schools work on, research centers, is strictly technology. And there's algorithms, there's compute power, there's hardware that facilitate kind of the problem solving piece. And so from that perspective, I would think because it's also mostly scalable. Maybe Ismek, you can go on mute. The technology is the key underpinning for also a scalable product, because you can like install it and replicate it much more easier than any other solution that's out there. So I think that that's the key driver for things that become VC scalable is that the technical solution is reproducible and gets better over time.
Okay. That's pretty clear, yeah. Well, I would like to give also the floor to our attendees here today and provide them the chance to ask a question to you. So are there any further questions from your side, everyone?
If I may.
Yes, Argyris.
Okay. Hi, Stereo. Nice to see you again. I would like to know how much of, if it is, of course, of a deal breaker is for you the concentration of a team to their, let's say, academic orientation. That is, not being able to, let's say, leave or dedicate too much time for the startup or all the time to the startup, as well as the mentality of gearing up funding towards grants, which is a different way of understanding, working, building your team, building your infrastructure. Of course, we know and understand that in order to fund all those monetary intensive projects, especially in deep tech, you need to have some money, and you cannot do research without funds. On the other hand, VCs have a very different mentality of moving ahead, and also most of the academics have built their career, have invested heavily and both heart and soul into building an academic profile.
Yeah.
So how you compromise those two?
Yeah, it's I think those are key career decisions that people need to push through. I'll add just a little bit of color on the timing. I think it's if something is a good idea and there's a team behind it, you can find VC money a lot quicker to drive what you need and grow than if you continue nurturing it through grants and processes that could take quite a bit of time. No one's saying that you can't combine the two. I've seen that work, but it needs diligence and being on top of things, including potentially some tie-ins with the grants to university affiliations and so on. So there's a lot of interdependencies. But if you go with the VC track, you're independent, you're off to the races, and you're driving things. What I have seen to your second observation, what I have seen in other countries happen when researchers just love doing, coming in and wearing their lab coat and going in and opening up the computers and one day driving one research area and then the next day driving another one because that's what their DNA is. I consider solving a problem, a real world problem with deep tech, a great thing that you can do for a period of time. So get out, experience this for 3, 4, 5 years, drive it to a certain level, and in parallel, find your replacement founders to actually push this to the next level. It could be your PhD students, it could be your master students. I've seen this happen so many times. And then these people go back to writing their papers, have the percentage of the company in their name. They continue to be, board members or advisors to the team. VCs support this. I've seen it happen many, many times.
But it's a kind of a founder spin-off, basically.
Yeah, exactly. Yeah. That's why when I mentioned earlier that finding the right team is critical. It could be the DNA of the team right from the beginning, right? It could be like three PhD students and one of them is an associate professor. They all get out. And then at some point in time, the associate professor wants to return and leaves the other two to move things forward with the appropriate stakes and ownerships all determined ahead of time, so you don't have surprises later.
Yeah, exactly. I think this is the key here. It's not
That
have
was
surprises later.
one of the things that one of the 5 teams that failed and one we invested in failed for exactly that reason. So that percent ownership is a big issue, and there could be people in the university system that can actually help such teams develop their journey in a win-win situation. So I can't put in writing what the recipe looks like for something like that, but it doesn't make sense to tell someone you got to go through an entrepreneurial path and that's it. No, you can have an entrepreneurial path as a founder in the private world and then also move back to research later, right? So, those things I've seen happen.
But it couldn't run in parallel.
No, it can't run in parallel. It just doesn't work. I'm not just trying to be also logical. When someone gives a team €1 million, you don't want them there part-time.
Yeah.
Right. And later, if things go well, even more. And on the flip side, have a big percentage of ownership of the company, and you're never on the premises. That just doesn't make sense, right? So it has to be, thought out well.
Yeah, absolutely. Okay. Well, thank you very much, Stelios, for your participation in the Pitch Clinic. And thank you very much for going into those deep insights in the questions raised. Some of the participants here are researchers, and they have participated in research projects, either from their company side or as researchers in universities or research organizations. So I really think that your answers helped everybody a lot to understand how a VC actually perceives when it is the right time, what are the necessary characteristics, and when a team should be ready to go out there and seek funding from a VC. Thank you very much for your participation again.
You're welcome.
Thank you.
Bye now. See ya.
Thanks, Dave.
Bye-bye.
And we can actually continue with the switch that we have made with the other workshop that we have planned for today. And this is on mastering the art of persuasive presentations for research-based startup. And this is about basically on how to present your research results to audiences that are non-experts, which might be very challenging. It is also for me because I have been a researcher and I have been called to present results in a non-technical way, which is really challenging for when you're dealing every day with the technical jargon. Let's say it's quite a demanding process to present everything in a very clear and understandable way for an audience that is non-expert. I'm going to share my screen now, and let's continue with the presentation. Just before doing that, are there any further questions on your side? Just let me share. Can you see my screen?
Yes, yes.
Okay, excellent. So I'm going to move this a little bit. Okay. All right, then. So basically, this seminar, this last hour seminar of today's Pitch Clinic is about exploring the craft of delivering influencer research presentations and try to perfect the art of articulating research findings that has an impact. The other bullet points that you can see here is the benefits that are expected for someone who has followed on the whole Pitch Clinic. So the overview of this seminar is about the importance of providing persuasive presentations for research-based startups. How can we capture investor and stakeholder interest? How can we present complex data in a simplified way? And why it is important to build credibility and trust as researchers with potential investors or potential stakeholders that we would like to partner with. What can differentiate us from the competition is an element that needs to be stated quite clearly. And all this exercise, all this process of trying to articulate research results in a simplified and understandable and a comprehensive way can guide also our business strategy. It is very important that we know our audience when we are talking, when we're giving presentation and pitches. And we will see how large companies, well-known companies, have used storytelling and examples to create, to engage audiences and build very large brands. At the end, we have a short workshop where you will be asked, participants will be asked to try to, let's say, articulate how your research, how the activities that you are engaged at the moment can have an impact, and you can try to explain it to everybody else with simple, let's say, sentences as a starting exercise of creating a persuasive presentation. So I'm going to start this presentation with providing you a number. This is the number that 354 billion euros are spent on research and development in EU. This is the number that concerns 2022 activities. However, even though this number is quite large and the investment in research activities is a large proportion of is a less proportion of EU spend of EU money spent. A very large proportion of this money does not necessarily mean that this research actually reaches the market or can be successfully commercialized. Why is this? In some cases, This can be basically influenced by many, many factors, such as access to funding, market demand, or regulatory barriers, or the ability of the researchers themselves to effectively communicate the value of their findings to potential stakeholders. In some cases, in addition, some further developments or refinements are necessary and will be needed to bridge the gap between research outcomes and market audiences. Why it is important to deliver persuasive presentations, especially when we are doing research. This can be important for numerous reasons, especially in the context of business or in sales or in communicating those ideas. And how much persuasive the presentations are can play a role in the success that we will have in the organizational growth that we are pursuing. Some examples of why we need persuasive presentations is, first of all, to secure investments. So effective presentations can play a leading role to secure investment, to try to convince a funding entity that this venture or the product development or the research initiative can convey the value and the potential research, the return on investment. So this is one of the most important reasons. Another reason is to drive sales. In a sales context, persuasive presentations can be influencing potential clients or potential customers, and it is important to effectively communicate what is the unique value proposition of a product or a service in order to ultimately drive sales. Then another key point is to influence decision-making. So having a persuasive presentation is sometimes powerful and can influence decision-making in different levels within an organization, from a project approval to actually creating a strategic partnership, or to identify or to reallocate resources to a specific project. So it can definitely influence this decision-making process. And in terms of leadership and team communication, sometimes leaders use these presentations in order to communicate vision, the company visions and the strategy, and in order to drive the organization change. And this is crucial, basically, for fostering a sense of a purpose and direction within the team. So persuasive presentations can have different perspectives and can serve different purposes, but they can help a lot in actually driving growth. One of the first things that needs to be achieved is to capture investors and stakeholders' interest. And most of the time, research-based startups actually rely on different funding that is most of the times external funding, coming from grants, coming from EU projects, and convincing the investors and the stakeholders of the value and the potential benefit of the research is a different exercise and requires most of the times an alternative approach. So the first thing is that we need to clearly define what is the problem. As Terje said before, one of the key features that makes a startup decide when to seek funding is that the company has reached a point where they can clearly define what is the problem or the opportunity the research is trying to address. What is the problem that the research is trying to solve? And highlighting how this research solves a problem and the potential benefits it can yield helps in clearly defining the opportunity in the market. Secondly, providing data and insights on the market size, the growth potential, and the specific need the research fulfills is also, sorry, and the research and that the research fulfills is also necessary, because this helps basically the investors and the stakeholders understand what is the larger picture and the potential business value. Then communicating the unique value proposition by articulating basically what sets your research apart from existing solutions or existing competitors is important. And one here should emphasize on any proprietary technology that the research team has already in hand, or any unique insights or any competitive advantages. These are elements that need to be highlighted when you're trying to communicate your unique value proposition. Then what is important in capturing investor and stakeholder interest is also to demonstrate any milestones that you have achieved, any traction that your research has gained already. So if you have any successful pilot studies, or if you have already some partnerships, or you have validated your product from some industry experts, then these are informations that need to be conveyed and demonstrated sufficiently. You use visuals and storytelling to paint a vivid picture of the impact your research can have. So it is quite important to show how it can address real-world challenges, your research can address real-world challenges, and how you can improve people's lives or business processes. Then it is also important to highlight the expertise and the experience of your research team. This is also one of the things that Stereos also pinpointed in the discussion we had before. So investors and stakeholders want really to know what the team is well equipped to execute on the research, and how they have the capacity to turn it in a successful venture. And last but not least, it is quite important to capture the interests of your audiences, of your investors, or of the stakeholders that you would like to partner, to outline a go-to-market strategy plan. So how you plan to commercialize your research. And this could include either potential revenue streams, this could include potential partnerships, and also target customer segments that you would like to address first. Now, simplifying complex data. This is one of the greatest challenges, especially when we are talking about research that is quite complex, is based on algorithms, is based on high technology, and those findings basically require some clear and accessible communication by non-experts. And some of the methods that you can consider in order to simplify this data, this complex data, is to tailor your communication to the specific knowledge level and the background of your audience, and use language and examples that resonate with them. So make sure that you understand who you're talking to, what is the audience that you are addressing, those information, what is the technical background, and what is the knowledge level, and also try to understand what types of questions that you might have from this kind of audiences. Then try to simplify and structure your information, break down your complex ideas into simpler, some more digestible components, and try to use clear and logical structures to present information, grouping related concepts and providing clear transitions between them. Try also to incorporate visual aids such as charts, graphs, diagrams, infographics are always a good way to help illustrate complex concepts. And those visuals, be sure that sometimes they can convey information more effectively than the text alone. So one picture, 1,000 words, try to use them in a most efficient way. Make sure you have some relatable analogies or metaphors that you can explain in an abstract way, or some more technical concepts in terms so that your audience understands them more clearly. And try to frame also your messages in a narrative that in a way that you can engage your audience and make the information more memorable. This is important because stories can always provide context and convey complex ideas in a more accessible way. In this presentation, in a while, we will share with you some example of well-known companies that are using in an efficient way the storytelling techniques. Try to avoid jargon and try to minimize the technical jargon mostly, and try to explain unfamiliar terms in simple language. This is very important when your topic is very, very technical, and this will help in preventing confusing the audience. Building credibility and trust. So building credibility and trust is actually essential, and actually it is essential when presenting research or ideas to stakeholders, investors, or even the public. Some of the strategies that can be used to build credibility and trust is to establish your expertise, showcase why your team has the expertise, and highlight your relevant qualifications, your past experience, your past successes in similar endeavors, and make sure that the audience understands that you have a background that can support the delivery of the value proposition, can support what you're promising. Then transparent communications is about your research methods. You can be open and transparent about the research methods that you have used. Any potential limitations, don't try to hide those limitations. Don't try to hide any challenges or any risks that you have encountered or you think that you will encounter in the future. Try to be transparent, because this will demonstrate authenticity and honesty, and these are values that will be appreciated by investors. Provide evidence to back up your claims. Try to provide any solid evidence that you have available, even if this is data from your research, even if this is testimonials from cases that you have tested your products, even if it is case studies or any other information that can support your work. Make sure you are consistent and reliable, especially when you have already opened a dialogue or you have already opened cooperation with a stakeholder or with an investor. It is absolutely vital that you meet all the deadlines, that you deliver on the promises that you make, and that you can maintain professional conduct. All those, because all those can contribute on building trust. Next thing is about building integrity and engaging basically with integrity. So adhering to any ethical standards and acting with integrity enhances also your credibility. And try to seek endorsements and partnerships, because endorsements and partnerships actually can help validate your research and your ideas, and these results can actually be communicated when the time comes with the investors or with the stakeholders that you would like to partner. As we said before, it's absolutely important to use language that it is simple, that it is comprehensive, and try to avoid any unnecessary jargon. And of course, make yourself accessible to those who have an interest in your work, and try to answer to any inquiries, to any feedback, to any questions they raise. All these features that we have described here can ensure that your credibility and trust can be built. Now, it is quite important that you are able to demonstrate how you differentiate from the competition. So to identify what sets your research or your startup apart from competitors is very important, and it is those elements in your unique value proposition that needs extra attention from your side in order to clearly differentiate what you're doing as in comparison with what other players in the market already have as a product or as a service. Try to translate those advantages of your research into benefits, tangible benefits. So try to link those advantages and the differentiating factors with your cost savings, with how your efficiency can be improved, or how your outcomes can be improved, and try to provide quantitative data on those tangible benefits. Illustrate the value proposition with concrete examples or use cases to demonstrate how your research can basically address the identified problem and can deliver a specific benefit either to the community or to a niche market. And emphasize any emotional impact that your research can bring by highlighting how your research can impact people's lives, can alleviate pain points, or can create a positive change in a compelling way. All these efforts in trying to create persuasive presentations and trying to build trust, credibility, but also trying to identify clearly what is the benefit, what is the impact that you're trying to deliver. Helps you also with your business strategy. So these persuasive presentations, when you're trying to build them, they can serve as a crucial platform for aligning your research with your strategic business goals. And in this way, you can demonstrate how your findings can drive your growth and your success in the future. By, as we said before, articulating clearly what is the market opportunity and the potential impact of the research on the company's overarching goals, and try to link the findings with the business strategic objectives. So in designing your business strategy, try always to have in mind what we are trying to pursue, how you are creating a difference, how you are creating an impact, And this will also guide you in the business strategy you're trying to design. It can also guide you to the financial sides of things, the financial impact, by offering you an opportunity to demonstrate how the research findings can translate into tangible financial outcomes for a startup, right? So by projecting potential revenue streams, by calculating the cost savings or what are the market expansion opportunities, you can illustrate what is the impact of your business. And for the startups that are seeking investment, creating a persuasive presentation is a chance basically to align your research with what investors' interests and expectations are, and by showing how the research addresses those market needs, what is the potential of substantial returns if the research reaches the market, you could potentially gain investors' support. And finally, you can also connect the research findings with the company's long-term vision and growth trajectory, and use this as a competitive advantage. So by connecting those findings, you can demonstrate what is the role of the research, what is the role of your research in shaping your company's future, and how you can address future market needs. And in this way, you can secure some support for long-term strategic initiatives. Another thing that is crucial when you are addressing an audience and you would like to secure some financial support is to know your audience very well, to understand what the audience needs, first of all. And this can include a variety of factors. For example, the audience, your audience might have specific challenges. So what you need to be in position to identify what are the particular problems or what are the particular obstacles that your audience is facing within an industry. That this will help you adapt your presentation better in order to address those needs and the specific challenges that they are facing. Your audience might also have some desired outcomes. For example, some specific goals, some aspirations some of the times, and they hope to achieve those goals through potential collaborations or solutions. So they might be seeking for a specific solution to achieve a certain goal. So it might worth to explore what are the desired outcomes of a potential collaboration with a specific audience. This is an important feature that you would like to work on before you prepare your presentation. And recognizing, of course, the knowledge level of the audience, the level of expertise that they have, or how familiar they are with the subject matter that you are going to present. It is always good to know in order to prepare appropriately. Your audience might also have specific pain points. This means that they might recognize specific inefficiencies, they might experience specific pain points, and they would like to have a solution that specifically addresses those issues. So it might be worth to know what are the specific pain points that your audience has. And there might also be cultural or contextual considerations. This is about, it can be relevant to societal or environmental concerns in which your audience might operate, which in this case might influence their preferences or their priorities. So make sure that you have all this background knowledge on the needs of your audience before you present before them. About their pain points in specific, these can include, as we said before, inefficiencies in processes. It might be something might be time consuming, something might be manually processed, which might hinder both productivity or efficiency. Other pain points can be cost and budgetary constraints. So there might be concerns about rising costs, budget limitations, or the need to maximize return on investments. Regulatory compliance, there might be also professionals that are operating in highly regulated industries, and those may face challenges because they need to navigate complex compliance requirements and changing regulations. So regulatory compliance might also be an issue when presenting a specific product or a service. There might also be competitive pressures. So business leaders, for example, might be concerned about maintaining a competitive edge, expanding market share, or addressing competitive threats. There might be technological barriers, and this means that in specific industries, there are technological challenges such as outdated systems, outdated technologies, or integration issues, or cybersecurity concerns that could be major pain points. So these features should also be taken into account. And then there are other pain points like customer satisfaction and retention. So professionals may focus on pain points related to client satisfaction, retention, or understanding evolving customer needs. So therefore, all those factors may play a role. And it's quite important that we understand all those pain points of the audiences that we are addressing in order to adapt the key messages on how we can address those pain points with our solution. Aspirations, there are certain aspirations that an audience might have, and this is depending on their specific roles, if they are an industry or if they have personal or professional objectives. So there are different kinds of aspirations that we might need to take into account. And some, let's say, most common aspirations that we have across the different audience segments might include basically professional growth and advancement. This is about professionals that aspire to advance their careers or take leadership roles or develop new skills that will allow them to progress. So certain aspirations have to do with these goals, professional goal and advancement. Other aspirations has to do with innovation and efficiency. In some industries, professionals might aspire to adopt innovative solutions because they want to improve operational efficiency, or they want to stay ahead of the competition, and they want to drive progress within their organizations. And other aspirations can include impact and contribution. This means that certain audiences may aspire to make a meaningful impact in their respective fields. And this is about contributing positively to any change, contributing positively to any societal progress, or contributing to industry innovation. So this is another type of aspiration that we could also take into account. Other aspirations might include financial success and stability, and this has to do with aspirations that aims to achieve financial success and sustainable growth for their organizations. Other aspirations include work-life balance. So many people would like to achieve a healthy balance between professional and personal lives, seeking opportunities that support their overall well-being, or they are seeking market leadership. So there are leaders that they want to achieve market leadership, and they are looking for solutions that establish this strong brand presence. So these are all aspirations that our audiences might have, and we should take into account. And now a way to build persuasive presentation has to do with our ability of the storytelling and the effort, our effort to build crafting a competitive narrative, which basically can emphasize on what impact you can make and how we can best engage our audiences and how we can drive some meaningful business outcomes. There are many examples. There are many well-known companies that have used the storytelling techniques to demonstrate impact, and they have successfully leveraged this storytelling to actually build their brand and connect their audiences on an emotional level, of course. And this is also something that has differentiated them from the rest of the market. Nike, for example, has a storytelling, is using basically storytelling to create powerful and emotional connections with the audiences. You all must know the Just Do It campaign, which basically has been basically used to convey stories of athletes who have achieved in overcoming specific challenges, who have pushed their limits, who have inspired with their effort others to do the same. And Nike has embraced these tactics in building their brand and has leveraged storytelling this way. Apple is another company that has well known for crafting compelling narratives around their products, focusing basically on the user experience and on the transformative, let's say, impact that their products have on the technology of the technology on their lives, on people's lives. They usually launched events and they used feature storytelling elements that highlighted the innovative nature of their products. And Steve Jobs was one of the people that started this. He was building on the iPhone's brand even before the actual device was out in the market. So he knew that a product that was going to be exceptional is going out to the market. He was building a nice story around it, and he emotionally engaged the audiences on the future launches of the Apple products. What lessons can we learn from Apple? Well, Jobs, what he actually did is to hook the audience first and then to introduce the product as a second phase. He did that by presenting a nice story about the product, building some suspense around the project. And the story was about how the customers could successfully use their product and how those products could eventually change their lives, how they could connect better to other people. So there was an emotional engagement on the future products of Apple. And then another business that has also leveraged on storytelling is Airbnb, that you all may well know of. And this storytelling approach focused basically on people and how they connected with each other, and how they build and how people who own homes are listed, and the travelers who go there can meet those owners and meet also local people in the place that they are visiting. And this is a very human approach by basically and worked perfectly for Airbnb in building their brand. And what we can learn, what we can take from Airbnb is their triggering question was, would people pick up my content from their coffee table and read it? So would you ask your questions for your research if you would be able to present your research or your results and your product basically, or your service that's coming out from your research? Would other people be interested in that? It's a very nice approach to bring it back to the human element. So how people can benefit from a specific product or a specific service, and try to be sincere and transparent as possible. Try to make people understand the real value of your products or of your services. And this can engage them emotionally. The human perspective can be more engaging. Okay, I think that was it on the basis of the theory that I would like to share with you in this seminar today. I have a short workshop that I would like us to run now, and this is about. Can I share this link? I would like you. Just let me copy this. Okay. Chat. I will share this link in the chat. And if you can go inside this link, what I would like us to do now is to try to answer a little bit those questions. So for your research, if you are engaged in a research, what would be your initial thoughts on the potential impact of your research? So what is the potential impact that your research has in terms of either environmental, social, economic, or technological aspects? Please let me know if you have any trouble connecting into this link. So have you been able to connect into the link that I have shared? Okay. We have a response, a flying snake, but okay. Let's try to answer the first one first. Okay, the first one is, what are your initial thoughts on the potential impact of your research? Are you all involved in some research? Or have you been involved in some research? I know some of you said that you have participated in the transnational access activities of VITALISE project. Okay, so you have some social impact, some technological impact, but what impact in particular in the social perspective? So is there an impact, for example, in reducing the energy bills for, I don't know, for energy communities? Or what impact in terms of technology? Are you creating a new technology that can change the way that people can achieve their goals? What type of impact your research can have? I know it's not an easy question. It's quite difficult to, you know, to convey what is the potential impact of your research. Anyone else?
Vivi, I was putting some responses in, but it didn't record.
Was it in this question?
I think so, maybe not.
Yeah, we have 5 responses
Anyway.
in the last question. If your research were to inspire a new innovation, what could that look like? So lessen environmental impact on air travel, development of AI for evaluation, the older emotional health, okay, environmental, lessen their travel emissions.
2 of them are mine. You can
Okay, all right. So these are some questions that I would like to share with you to trigger the discussion in your mind, but also with your teams about what is the impact that we're trying to do with our research, what is the problem that we're trying to solve, and for example, how we could influence the practices, the existing practices, or the policies in an industry. These are questions that might influence the way that we are trying to present our research result, or might influence the way that we would like to articulate how we are solving a problem, a specific problem in the market. I can leave this with you at the moment, and maybe you can take some more time to think about those questions, because we will be sharing those slides in any way, so you can find those questions already here at the last slide of this presentation. Are there any other questions on your side?
I think, Vivi, we can use these questions also on Thursday to help with the value proposition, to help frame the way we're going to develop a very good and clear value proposition.
Yes, so, absolutely. Yeah, we can leave it here, and we can take it. Yes, I think we have hands up, Fationa.
Yeah, yes, thank you very much for your presentation, as well as for the presentation of the Adrian, especially for a researcher that wants to start up to create a startup is very useful, especially for the financial part, because as a researcher, and if we want to create a consortium, the financial part and to engage investors is the most difficult part. But as well as researchers, this part of workshop to create presentations that can attract the audiences are very important. And I found your presentation, Paraskevi, very, very useful and very practical, especially for the cases if you have a research protocol and you have published it, a research protocol of a research project, and you want to attract the investors, and you want to find what is the best strategy to engage them and to find them to be part of this project and to invest in your project. Actually, I have published two research projects, and I have to say I have presented that projects in two international conferences, but I didn't receive yet any potential investor that want to be part of this project and to invest, to carry out and to implement the project. So I will also study in depth your presentation. Maybe I will find there some secrets to represent this research protocol projects, and maybe I can be successful in the future. Because if you have an idea and you have this idea, research idea, in a specific point of time, and the time is running, is very difficult also to find the correct time to implement it. So it's very difficult from the perspective of researchers if you are also in low resource settings, and it is very difficult to engage also the researchers, but the most important, the financial part, the investors. So thank you very much. For me personally, it was very useful to be part of this work webinar and these training activities today.
Thank you very much for your comments, Fatjona. Just one very quick remark on what you have said, and then we can pick it up in the next session. It's quite important when you are trying to find someone to invest to clearly identify who you are aiming at. I mean, are you aiming at a venture capital? Are you aiming at a grant? Are you aiming at a national funding mechanism or an EU funding mechanism? It is the way that we should try to present our project should differentiate depending on what is the end goal. So what type of funding we are looking for, and of course, yeah, which audience we are addressing the proposal. But be sure that in conferences that you rarely find investors from VCs. You might mostly find researchers, other researchers who are the same interests, perhaps in the research topic, but not very often someone that we would like to invest in.
Yes, that is true.
There are different kinds of events that you should be aiming at if you're trying.
Maybe I have to go to the business and to attract more business partners and to find if they have relevant interest with the research idea. And
yeah, but we will
very important
touch on all those aspects in the next sessions of the Pitch Clinic. And well, thank you very much, everyone, for participating. And thank you, Adrian, also, if you want to share with us any last words before we close today.
Just as you said, thanks very much to everybody. And we hope to see you all back on Thursday. We will do more workshopping and a little less presenting, hopefully. In the first part, and then in the second, we actually have another guest speaker who will talk about the kinds of assistance that the EU offers through various different programs. So EIT, EIC, and so forth, and that will be also, we hope, very helpful. So, Fatjona?
Yes, I have one more question, if it will be possible to share with us the presentation. because it was a lot of information, and maybe we have to return back to consult if we want to create something and to consolidate what we have learned today.
Yes, the material will be available to all the participants, and
Okay,
we will
thank you.
notify you with all the material that is available after the clinic concludes. Yeah.
Okay.
Okay, everyone, thank you very much for being with us today, and we'll see you on Thursday, on the 15th of February. Thank you. Bye-bye.
Thank you.
Nice evening.
Bye.
Thank you. Bye bye.
Bye-bye.